Welcome to a demonstration of my new planning software. As I mentioned in the email I sent out, this is replacing the previous software we were using. I'm just going to walk you through a quick setup process, show you how this is used to help, you know, plan out financial situations and potential outcomes. We have Mr. John Smith here. We'll plan individual, born January 1990. Note everything in US dollars. That all looks good. Then let's say we're going to have some savings, put some money in a 401k that he owns a home and has some student loan debt as well. So let's put 15,000 in savings, put 2,000 in 401k. Say he owns a home, purchased it for 100,000, currently valued at 228,000, and he's still financing it. Goes 178,000 at percent, and he's making $1,000 monthly payments on it. So that will be paid off in 23 years. Then say some student loan debt, $10,000 percent, and a $300 monthly payment that will be paid off in 3. Okay. So when you first set up your account for the first time, it'll look pretty barren. Any clients currently paying for financial planning service, you'll receive a link to this dashboard. You'll be able to make any changes and play around with it, but you won't be able to save any changes. I'll show you what a more complete dashboard looks like towards the end of this video, but let's move into the plan. Start from now. Righty, so change the goals here. I'm actually going to get rid of the default financial independence goal. And we're going to retire either at age 65 or when our liquid net worth is 25 times our total expense. And so maybe we won't get to it in this video, but we could talk about the idea of retiring early. How much do you have to save to hit that retirement goal and retire before the age of 65? And I'll rename this the base plan because we're going to make a copy of this and look at some different options and outcomes later in the video. And then last thing, I will bump the life expectancy just up to 100. I think it is better to plan for a longer life. That way you don't accidentally outlive your money. We'll leave the rates of return at the default for now, but that's something else that we could model different outcomes. Income, let's say Mr. John Smith, $85,000 a year, and it grows at 5%. But let's say he's not expecting to ever be compensated more than $150,000 in today's currency. We'll leave everything else as default for now. And then we get into cash flow priorities. This is how you want to spend your money, and this is where we can start to talk about more specific strategies, investing a certain amount, paying down certain debts. Dive into that. So let's start. Say he has a 401k, contributes 3%, and they match 100% of that 3%. He contributes 3% of his earnings to a 401k. Then I'll actually set up another account here. Let's say he also wants to start saving 30% of his remaining income into a taxable investment account. And then I will put this as spend anything left over. Um, we'll move into more fixed expenses. We have the student loan debt, and this, as it said on the previous screen, this will exclude the mortgage. Um, we will revisit that on the next page. Let's just say he lives fairly frugally. Put 25,000 into plan, and it matches in. There's a $25,000 living expense. And then here's the mortgage payment we already put in. We're currently financing our home. Then we'll leave tax assumptions as the default for now. So this is the chart of the net worth. I actually like the stacked net worth a little bit better. It breaks it down by account. You have your age down here. Field change. Yeah, you can change it to either year or age. And then these icons represent some of these milestones. So at age 38, we're expected to pay off student loans. We can see that at our current rate, we'll pay off the mortgage at 58. 64 is our last year of salary. We'll retire at 65. We have to start taking some required minimum distributions. Now, as you see, we're projecting to end with a liquid net worth of a little over 2 million. So once John enters retirement, his assets actually grow faster than his expenses, or grow more than his expenses, I should say. So this is a pretty healthy retirement savings. So we may actually have some options, some flexibility in the plan. Yes, let's travel is a pretty common goal. So let's plan a cruise. So let's add another savings account. Let's call this Alaska Cruise. Alaskan. Alrighty. And then we'll add a milestone. Call this first cruise. And we will take this cruise when our Alaskan cruise balance is greater than $5,000. Then let's go back to the plan and add another savings goal. So let's say we want to build up to $5,000. Let's say we're saving $150 a month towards the cruise. And that will go from now till we take the cruise. So we can use these milestones to turn on and off different savings goals. Add that. So it looks like we will reach our goal at age 38. And then one more thing is I do have to add that then as an expense. Add a travel expense, $5,000. It will occur once. Take the cruise. All right. And then hold on, one more thing. I did want under advanced settings or more options. Fund with specific Alaska. All right. Because we don't want to tap into investments or anything else. We want to specifically pay it down with that account. Okay. All right, 65. And still pretty healthy net worth at the end. Let's say, want to cruise, or there's more than cruising. It's just the first thing that pops into my head. Let's budget for a 5,000 yearly travel expense starting in retirement. Match inflation. Okay. All right, and now we can see the shape of the graph changing. So now we have this new We have this new milestone that once we enter retirement, we will start paying 5,000 a year in travel. Um, Now our liquid net worth at the end of the plan is a little under. It's 1.7. Maybe we still some more planning opportunities that can be done. Um, but let's also, so that whatever you want. This is where you can start talking getting married, planning honeymoons, planning children. There's still a lot of slack left in the plan. Say that you could spend a little bit more and live life a little bit more to the fullest. Let me now add a new plan. I will clone the existing plan. Base plan I will clone. We're gonna skip this. And so from this clone, let's say we want to look at the effects of paying off mortgage early. Okay, so now we can go back to cash flow priorities. And we're saving into a 401k, we're investing to a taxable investment account, we're saving for our cruise. And let's pay extra towards the house payment. And so let's say that we take 50% of our discretionary income remaining at that stage and put that towards the mortgage to pay it off sooner. All right, and then you can already see that milestone moved up a little bit. Let's start comparing it to the base plan. So looks like we would pay off the mortgage 11 years sooner. If we put half of our discretionary income towards the mortgage, that at the end of the plan results in a about $250,000 increase in net worth. So that comes from a couple things. Is because we're paying off the mortgage sooner, we have more discretionary income to then invest in that taxable account. So we're investing more early, and that's allowed to grow for a longer period of time. Like I said, it's paying off the mortgage early in this case. Like I said, this is just a real quick example. About $250,000 difference. The part people might be more interested in is expenses breakdown. Turn off compare for now. So the expenses breakdown. So this, is very similar to the stacks net worth. It just stacks all the different expenses. And let me change this to table. And it's this column, house mortgage interest. That a lot of people that I've spoken to, this is where the savings comes from for them. And so there is an option to export as a table. And so we can see that we have fewer interest payments. And so I have already exported these sheets before this recording and had done the math. And so in the base plan, we're paying about closer to $75,000 in interest just over the lifetime of the loan. But if we pay it down sooner, it's just north of $50,000. So it comes out to around $23,000 in savings just in the interest paid. So in this instance, paying half of your discretionary income towards the mortgage saves about $23,000 over the lifetime of the loan. Real quickly, I want to show a couple of the other pre-built demo accounts that they have, just to show some of the other things this is capable of. Okay, so now we have Jane Smith here. We will go into sandbox mode. Let's go early career, married. Yes, that's the one I wanted. All right, so here you can see immediately on the dashboard there are many more data points here. I opened the profile, so it generated another point that should be the same as the previous point. But we can go in and update this quarterly, just do little checkups, and let's go into this view. So this is the real life, updates of progress towards the plan, and it's overlaid on our project. Let me go into progress and actually day's point. That's a little bit unfair. Like it generated that one automatically. So as of the last time Miss Jane Smith's plan would have been updated, she's maybe a little bit behind our net worth projections. Yeah, that one doesn't show it as well. But this is useful information that what real life habits do we go through, look at credit card statements, spending, figure out where we may need to cut or where we can cut, how much more do we need to save, and what tweaks we need to make to get us back on track. So this is a little bit more is the other account. I just set it up real quick and it just had the one set of data points. But as you use this more and more, gets fed in more data, it gets a more complete graph here. This also shows that you can plan cost of having children, upgrading to an SUV, all those things. So, and almost any financial life goal can be modeled or projected in this software. So, just once again, for current client receiving ongoing financial planning, look for a link to your dashboard in coming days. If you are an investment management only client or anyone else watching this video, feel free to reach out if you think that may be useful for you. And if you have gotten to this point in the video, thank you so much for watching.